440K now. What the F? You make like 10K a month in a bear market. SB replied saying, I know, lol. I hold the same stuff. Obviously, Kyle is adding cash, which your income is a big part of growing your portfolio. And again, J Tree replying saying, yes, but how does he have so much extra cash every month? Because I make 6 figures a year. I am a marketer. I'm like in this marketing agency. I work for a company. I work for myself, and I make some pretty healthy income, which is why I always laugh when I see comments like this. Oh, Mike saying index funds, yawn, super boring. I love my index funds. Obviously, I have some small cap investments, a little more exciting, but they're mitigated. When you're managing, a 6-figure portfolio, I don't like the crazy fluctuations in this Fugazi market where you post bad earnings and your stock still goes up. How do you predict this stuff? I don't want to predict it. I just want balance, stability, income. My portfolio moves a couple percentage points in a day, and we're talking about like $10,000+. So you got to take a breath, guys. Roll back. And I want to answer some of your comments, questions, these Canadian dividend stocks, the broader market in general. Let's get right into this with Q&A numero uno coming from Patrick. Great. Any thoughts on Allied Properties' recent earnings and the office retail space? Not the best results, but has that already been priced in? This is so fascinating. Let's talk about some of the REITs. Let's talk about some U.S. medical REITs, office REITs, starting with Allied here, which kind of blows my mind because this thing started to tank on those recent earnings. Look at it. It's down like 6% here on its recent earnings. It's paying almost an 8% dividend yield and seems to always find a brand new low. Is this justified? Is it deserved? Why it's dropping? Well, I dug around, give you a little bit of insight on those recent earnings. And what's really pressuring people, as mentioned, they had really low interest rates for a long time. And we can see their interest expense went up by 48%, really eating into that cash flow. Their total revenues, though, rental revenue actually went up. We heard the CEO, I mentioned this, as the CEO basically said that, hey, from an operational standpoint, office REITs are doing just fine here in Canada. It's just obviously there's a fixation on it about, work from home lifestyle, and Toronto real estate is so highly valued. These people even have, a stake in the Well, that massive RioCan development property on like Front Street in Toronto. I mean, this company is resilient from so many aspects. And let's just talk about the payout ratio. I mean, it's only at 77.6%, so they can't afford the dividend currently. And when we're talking about debt to asset ratios here, let's scroll down a little bit more here. What do we got? Oh, look at that. Total indebtedness is only 36.5%. Find me another REIT that has only a debt of 36% to their assets. This thing is one of these things where it's like, I want to buy it. Should I buy it? Is it a buying opportunity of a lifetime? If you can deal with perhaps continued downside pressure, oh God, it kind of reminds me of Medical Properties Trust. This thing, U.S. medical REIT, is probably going to see a short squeeze here soon. I've been talking about this, and I think it's coming. Let's take a look at the last 6 months, because off its lows, it is up 20.63%. And this thing is kind of mind-boggling, the drama they went through recently. And just taking a look, it's the most shorted REIT, or one of them. I mean, the short interest is in the 20% range, which, 27% short of percentage float. There's a lot going on here from a negative news standpoint that's finally starting to shift, because on the recent earnings, Medical Properties Trust is briefing up its supplementals with all the information analysts could want. Transparency in MPW's filings appear to now be far greater than that of peers. No new problems in the report and strong resolutions to previous problems. I've been reading through a ton of these articles, and it looks like they're resolving a lot of issues. They've been able to sell properties and actually make money on those properties sold to pay down some of the debts and issues and other aspects of their portfolio. And taking a look again, look at the dividend on this sucker. We're talking about 13.23%. And a lot of people look at this saying, can they even afford that dividend when their net income was 0.50%? But I laugh at you guys because you got to look at the balance sheet, baby. I always said, these companies write down the asset values of their real estate. It doesn't directly impact their cash flow, which for funds from operations being 37 cents for this quarter. If we scroll all the way down here and we just take a look at the dividend payout, what was their dividend payout here? Where can we find that? Let's keep scrolling. We got net income. There we go. So dividends declared per share was 29 cents. So they can definitely afford that dividend. So these are two fascinating REITs that I really implore you guys to dig deeper down into, that could be very, discounted buying opportunities. Maybe I should just buy them as a joke for this channel and just follow them. Allied Properties, Medical Properties, just buy the two most hated REITs, one of the most hated REIT in the US and one of the most hated REITs in Canada, and just see how it works out over the next year or two. I mean, my yields would be absurd, and for now, they can afford it. For now, I think they should be able to continue that moving forward. But nonetheless, this kind of falls in line with things like Northwest Healthcare here in Canada. This is like Canada's counterpart to MPW, and it pays almost a 10% yield, and it just got slaughtered recently. It's down 43%. I got to do research on this one. We're getting some earnings coming out for these, like RioCan will be watching coming up in the next couple of weeks. But taking a little bit deeper, let's see what Matthew has to say. He says, what do you think of the cash ETF by Horizons, roughly a 5% yearly paid monthly dividend or buy-in after the dividend resets and sell before dividend resets if not in a tax sheltered account? It doesn't really matter if you buy in before or after it resets, because you'll just get paid out whatever it is in a dividend. If you guys have never heard of these, they're basically high interest savings account stocks. There's no volatility risk to them at all. Basically, they trade for around $50. They build up interest in these accounts and they just pay you the interest, at which you could sell out whenever you want. You take a look. So right now, most of the portfolio is in national bank cash accounts and CIBC cash accounts, which clearly are yielding very high amounts. You got Scotiabank cash accounts in here. And again, this thing is yielding. We take a look at the product facts here. We're yielding, well, there's a management fee of about 0.11%, but the gross yield is 4.95% minus the management fee. You're still bringing in 4.85%. Like, you're bringing in a crazy amount on an annual basis. So why wouldn't I buy these? Why don't I buy them? Firstly, these are a great proponent, I think, for a short-term Parker place for cash. But instead of using these, to be honest, what I would prefer is a GIC, like a short-term GIC, maybe a one-year GIC that's cashable in 30 days. You could still probably get about a 4% yield on that. But the reason I choose a GIC over this is, for some reason, these stocks, even though they're liquid, they're easy to get in and out of, the thing that bothers me is they're not CDIC insured, which means if the company went under for whatever reason, you have risk of losing your capital, which makes no sense to me, because these bank accounts they put your money in are CDIC insured, but this investment vehicle itself is not, which I find very intriguing. But nonetheless, if you have money and you just want to collect some cash while the interest rates are so high, because again, even these companies say that these are just good for short-term Parker places, you know, zero volatility, 5% return roughly for the time being until interest rates come down. But I take advantage of it if it's something you're comfortable with. I just wouldn't put an emergency fund in here, and that's what I look to do with my cash. I want a place where it's 100% secure, CDIC insured. So GICs are, and obviously savings accounts are. So Scotiabank right now pays me about 2.3 or 4%, and that's where most of my cash flow comes from. It's, you know, I'm missing out on an extra couple percent here, but give or take, it's not the end of the world on, you know, the 30 or 40 grand of cash that I'm sitting on. But FitBH says, would you ever consider adding QQM, Kyle? Would give you some indirect exposure to the companies you mentioned a lot. Yeah, this is something, you know, with Meta, Tesla, Google, if you're into tech companies, QQQs, the QQQM could be a good proponent, kind of representing the NASDAQ 100 ETF. Now, I haven't bought back into these. I kind of just like the S&P 500, and I'll explain to you why. Honestly, I could give or take this as a small percentage of my portfolio because it's heavily weighted in just things like Microsoft, Apple, Amazon. I mean, these three companies alone making up over 30% of the entire holdings. My fear with this is the valuations on the S&P and the NASDAQ are excessive right now, which is why I like balancing most of my investments out with dividend ETFs and the Canadian markets. Now, I'll talk a little bit about the risk with that, because the NASDAQ here, if we go back to the dot-com bubble when things were way overhyped, I mean, you didn't see a return if you were buying those peaks. You obviously want to be cost averaging in these, but you had to wait till 2017 roughly to start seeing a return if you bought the peaks in an overvalued market. And if we take a look at something like the S&P 500, if we can kind of rally up to one of these peaks here, you started seeing a really decent return coming back roughly by 2013, 2014 if you bought the peaks of the dot-com bubble. And by 2017, I mean, you were up like 50, 56%. So having that broader exposure and not so concentrated in tech companies really paid off during overvalued periods if you were buying the broader ETF or the broader US market. So, you know, from a safety and security standpoint, I'm kind of on the fence with it. It's something that I think could be a good little proponent, because when we take a look at the PE ratios right now, if you listen to Everything Money, a lot of these YouTubers, they constantly iterate that the markets are still excessively expensive to historical norms. Like, we're still in the upper bounds of the S&P, where a median is usually around 15, and we're right now at 22, meaning that, you know, there could still potentially be some downside in the market if GDP doesn't stay excessively high. I mean, you look at the NASDAQ PE sitting around 23.8, and if you go back 10 years ago, it was at like 6 to even 15, kind of falling more in line with the S&P 500. But all of this is based on the U.S. economic growth, which historically you can kind of see from the 1950s coming into the early 2000s. It was very a slow arc, but thanks to technology, iPhones, AI software, robotics, and all this stuff adding to GDP, you know, we're seeing this massive upswing in even from the pandemic lows there. Like, GDP has been exploding. So if gross domestic product, which is just, the transfer of dollars, wealth, all this stuff going on in the economy continues to grow at an exponential rate here, I think it's hard to say that the market's overvalued. It really comes down to GDP growth. So yeah, if you want the proponent of growth in your portfolio, I like the Qs. I got nothing against them. I would just, in a market like this, prefer the S&P, but who knows, maybe I'll add it sometime in the future. And again, this is why I like the Canadian market so much, and I think they could have potential for better returns if the recession hits hard. I don't think it's going to hit hard. As mentioned, I think we're finally seeing some of the bottoms. This could truly be the first soft landing ever. I could be wrong. Time will tell. But if we take a look at the PE ratio on, say, something like XIU, which is the S&P TSX 60, so similar to the S&P 500, Canada's 60 largest companies. Our economy is not as big as the U.S., so the 60 largest companies is very similar to the 500 largest in the U.S., but the PE ratio is under 14. So you're getting a much better deal on the valuation of Canadian companies, right? And we're heading into a big earnings season. I mean, you take a look at Royal Bank. I mean, it's trading at a PE of 12.8 right now with a really healthy dividend yield, being Canada's largest company at $186 billion market cap. Nothing like Apple at its multi-trillion-dollar market cap, but the earnings are coming out in the next couple of weeks, so this will be fun to watch. Or I think the banks are more toward the end of the month of May, but I'll be doing updates, so consider subscribing for that. Shopify will be a fun one to watch in the next couple of weeks. Some of Canada's bigger tech companies next to things like Constellation Software, things I'll be keeping an eye on. Obviously, our telecom giants like TELUS and Bell, which, as mentioned, this will give some really good insight to how the economy is performing here in Canada versus the U.S., considering how flat most of the U.S. earnings have been thus far, yet the stocks have rallied greatly. I mean, the earnings weren't that bad, right? Meta is, maybe the exception, but we still got Apple left for the U.S. earnings. But I'll pass the question off to you. I'd love to know what you think about this conversation in that comment section below.